Let's talk about money. It's everywhere, right? It runs our world, but so much of how it actually works can feel, well, super confusing, hidden behind all this crazy jargon. Not anymore. We're going to pull back the curtain on the core financial ideas that everyone should know, and we're going to start with a feeling I guarantee you've had before.
Oh, yeah, we've all been there. You put in the hours, you see that glorious paycheck notification pop up on your phone, you get excited, but then you open your banking app and the number is smaller, like a lot smaller. It's that universal moment of, wait, what just happened?
That is the $1,000,000 question, isn't it? Or, in this case, the $544 question. It feels like a magician just made a chunk of your money vanish into thin air. Well, it didn't just disappear. There are these kind of invisible forces at play, and we're about to shine a big spotlight right on them. So first up, let's get into the behind-the-scenes systems that manage our money, move it around, and yes, take a piece of it, often before we even see it. This is the basic flow of how money gets from your boss into your pocket, and then, well, out of your pocket again. That first big chunk of your missing cash? Yep, you guessed it, taxes. You can think of it like your subscription fee for living in a society. Seriously, it's what pays for the roads you drive on, for schools, for public parks, all that stuff. It's the mandatory contribution we all chip in to keep the whole system running. Okay, so you take what's left and you put it in the bank, right? You probably imagine it sitting safe in a giant vault with your name on it. Well, plot twist, it's not. The second you deposit your money, the bank keeps a tiny little bit of it and then immediately lends the rest out to somebody else. This whole system is called fractional reserve banking, and it basically runs on one big bet, that all of us aren't going to show up and ask for all of our money back at the exact same time. Now, before you start panicking and thinking about stuffing cash under your mattress, hold on. There is a safety net. Here in the US, your deposits are typically insured by the government, by the FDIC, for up to $250,000. So even if your bank makes a bad loan to someone for a jet ski and they can't pay it back, your money is still safe. All right, next up, let's talk about the tools you can actually use in your financial life. But I gotta warn you, these are like a double-edged sword. Used one way, they can build you a fortress of wealth. Used the other way, they can dig you into a really, really deep hole. And the sharpest tool in that box is interest. It's so simple but so powerful. When you borrow money, interest is just the fee you pay for the convenience. It's your enemy. But when you save or invest money, interest is the reward you get for your patience. It becomes your best employee, working for you 24/7. And this is where it gets really dangerous, especially with credit cards, because that interest compounds. If you don't pay your bill in full, you suddenly start paying interest on your interest. All of a sudden, that $12 burrito you swiped your card for starts to spiral, and before you know it, it's a $50 regret that follows you around for months. So you can see how compounding is this two-faced beast, right? On one side, it's the debt snowball. It just rolls downhill, getting bigger and faster and more destructive. But on the other side, it's literally the wealth cheat code. Your money starts making babies, and then those babies start making their own babies. It is the silent, powerful engine behind both financial disaster and incredible fortunes. So how do lenders even decide how much interest to charge you? Well, they look at this kind of magic number, your credit score. And here's the thing a lot of people get wrong. It has nothing to do with how rich you are. It is purely a measure of trust. It's like a report card that answers one question for lenders. If I lend this person money, am I going to get it back? These scores usually run from 300 up to 850. If you're down below 580, you look like a pretty big risk. But if you can get your score up into the high 700s or even over 800, you look like a financial superhero. Lenders will basically roll out the red carpet for you, offering you the best interest rates on everything from a car loan to a mortgage. So what's the big secret? How do you get a good score? Honestly, it's way simpler than you think. Look at this chart. The biggest piece of the pie, by a long shot, is just your payment history. That's it. Pay your bills on time every single time. If you do nothing else, just focus on that. It is the absolute #1 rule of the game. Okay, we've been talking about all the personal stuff, right? But our own finances don't just exist in a little bubble. So now we're going to zoom out and look at the big macroeconomic forces that affect everybody's wallet. Think of this as the economic weather report. You know that feeling of pure disappointment? You open a brand new bag of chips and it's already like half empty? Yeah, that feeling of being totally ripped off, that's basically inflation in a nutshell. It's this slow, sneaky process where your money just buys less over time.
A $5 bill is still a $5 bill, but the bag of chips it buys just keeps getting smaller.
So, why does this happen? Well, it can be a few different things. Sometimes it's the classic case of too much money chasing too few goods. Other times it gets more expensive to make stuff and ship it around. And here's the really weird part. Sometimes it's just in our heads. If we all expect prices to go up, we tend to spend our money faster, which ironically causes prices to go up. It becomes a self-fulfilling prophecy.
Now, if inflation is like the economy overheating, a recession is when it catches a really bad cold. Officially, it's when the whole economy actually shrinks for 6 months straight. Companies start laying people off, everyone gets nervous and stops spending money, and the whole vibe just gets tense. It feels like the party's over. But here's the key thing to remember about recessions. As painful as they are a totally normal part of the cycle. The economy's kind of like a big party. You have the boom times when things are great, then you hit a peak when the lights start to flicker, then comes the bust, the recession. But after every bust, there is always a reset, and the slow process of rebuilding begins all over again. Okay, we've talked about how your money is taken and how it can lose its value over time. That's all been about playing defense. So now, it's time to switch to offense. How do you stop just protecting your money and start actively making it work for you? The answer is investing. This is how you fight back against inflation and actually grow your wealth. Instead of just trading your time for money, you start using your money to make more money. You can buy stocks, which are just tiny little ownership slices of a company. You can buy bonds, where you're basically the one loaning out the money. Or you can buy funds, which are like pre-made baskets of stocks and bonds. The whole goal is to get your money to start earning an income, so you don't always have to. But to invest well, you gotta wrap your head around this really weird concept called value. Think about it. A plain old rock from your backyard. It's just a rock. But a shiny yellow rock that we call gold, we've all just kind of collectively decided that it's super valuable because it's rare. It's the same with a company. When you invest, you're not just buying what it's worth today. You're betting on the story of its future value, a story that you hope everyone else starts to believe too. And that leads us to the single most powerful tool in your financial toolbox. And it's not a hot stock tip or having a huge salary. It's simply time. Because of that compounding magic we talked about, a little bit of money invested consistently over a really long time can grow into an absolute fortune. Most wealthy people didn't just get lucky, they just got started early and gave their money decades to grow up. And that really brings us to the final, most important takeaway here. You see how all these concepts, debt, saving, investing, they all revolve around the incredible power of interest. It can work against you day and night, or it can work for you day and night. It can be your worst enemy, or it can be your best, hardest working, unpaid employee. The only difference is whether you're the one paying it or you're the one collecting it. The choice is yours.